deal making is definitely back in 2014 and it's the real deal.
We are back in the boom times. If you look at it in pure number terms, we are very much back in the boom times.
I wouldn't talk about M&A hype. We're talking about real strategic underpinning of resumption of M&A activity across sectors.
After years of stock market volatility and uncertainty, deal-making is back. Global merger and activity volumes have just passed the $1 trillion mark, the first time the figure has been reached at this point of the year since 2007. And 2014 has already seen a number of eye-catching deals.
You've had the Lafarge Holcim tie-up, which is a fascinating $40 billion merger of the two biggest cement makers in the world. That's a great one because it's going to have all of these regulatory issues, antitrust issues. You've had one last week, which was the activist investor Bill Ackman teaming up with Valiant to make a hostile bid for Allergan, which is the maker of Botox. Again, that's a fascinating one. The marriage of an activist investor and a more traditional corporate is a sort of new theme. And then really just in the last couple of days, we've seen Pfizer make public its interest for AstraZeneca, its UK rival, and then obviously we've had Facebook and WhatsApp in the tech space.
So what's the catalyst for all of these deals? Well, companies are sitting on bigger cash reserves. Then you've got activist investors lobbying companies to spend that cash, either by doing deals or by returning the money to shareholders. Credit conditions are improving too, and perhaps crucially, chief executive confidence is beginning to return.
Once someone completes a big deal or someone announces a big deal, other people in the sector think, well, hold on, maybe now's our time, maybe the favourable market conditions that we have at the moment won't last indefinitely. So let's move. So I think what you have is you have the right conditions and then this last piece of the puzzle, which is the sort of boardroom confidence to go and actually execute these deals, has finally come into place.
While interest rates remain low and financing is cheap, the rationale to acquire now is high. At the start of the year, investors had been widely expecting interest rates to rise. That hasn't happened. And with the rate increase potentially not coming until 2015, M&A activity might only increase further.
We have all the ingredients to have a resurgence of M&A across the board, very driven by industrial and strategic considerations. The availability of financing is also, to a certain extent, augmenting the capability of companies to profit from those transactions. You really want to accelerate your access to that debt financing while rates and capacity in the market is significant, because it may not be there in 12 months.
But while there's been a lot of talk both on Wall Street and here in the City of London about the return to the boom times in M&A, the way that the deals are now being financed and the types of deals that are being done has changed.
Whereas in 2007, companies were borrowing huge amounts to finance these takeovers, especially private equity. This time, we're seeing a much more measured approach with the use of stock and cash. Several of the deals coming out have been on the agenda for a long time, and it's just that now all the stars are aligning to be able to make them happen. They're not these blockbuster deals that we saw in the first round, and investors seem to be happy to be seeing companies spend their cash this way.
There are still questions as to the sustainability of the recovery in most of the economies in the Western world and globally. But stability and stock market performance over the last 12 months helps rebuilding some confidence to bring to market some transactions that were logical from an industrial point of view.
But while the deals in 2014 have largely been the strategic and thoughtful ones that you see at the beginning of an M&A cycle, things can quickly change.
I think inevitably we'll return to some of the excesses. There's endless studies done after every M&A cycle which show that they destroy a lot of shareholder value, but they also add value. And if the alternative is share buybacks for companies, then it's not necessarily always going to win over buying growth.
Concerns about the sustainability of the recovery remain, and any unexpected economic shockwaves could still impact the M&A landscape. But for now at least, all the conditions point to 2014 being the year when the deal-making cycle finally turns. Daniel Garrahan, Financial Times, London.